Good afternoon, everyone. Welcome. Thank you for joining us for the third installment of our Lunch and Learn webinar series sponsored by NYSERDA. Today, we are focusing on non-dilutive funding options and capital strategy. We're very excited to have Jillian Francis here with us. She's founder and managing partner for Rapid Ventures, as well as Marnie Levine, president and CEO at Launch New York. We will get into the agenda. Today, brief housekeeping as we get started. We are on mute at the moment. However, there will be time at the end of the webinar for an open Q&A. So we encourage you to please send in your questions, and also you can use the chat function here on Zoom or raise your hand. We will be hearing from Marnie Levine, Launch New York's president and CEO first, giving a brief description about our eco-programming as well as Launch. And then we will be hearing from Jillian Francis, again, founder and managing partner at Rapid Ventures. She's going to be putting a great presentation for everybody today. And then we will have a moderated Q&A portion of the webinar. We also, before we jump in, this is the third of 4 webinars that are sponsored by NYSERDA. We're excited that the next webinar is coming up on July 9th. It's focused on community partnerships and clean energy projects and manufacturing. There is a QR code on your screen that you can scan now and register today. So we do encourage you to do that. We'd love to have you all join us for the 4th and final installment of our Lunch and Learn series. And now I will pass it to Marnie Levine, President and CEO of Launch New York.
Thanks so much, Taylor, and welcome everyone. We're excited to talk more about the financing piece. We know that's so critical in our startup ecosystem. So I appreciate a few minutes up front, give you a little background on Launch. We come at this from the equity side. So it's been terrific for us probably 6 or 9 months ago, we announced a partnership with Rapid Ventures that would really help us address sort of the non-dilutive funding side of the equation that we know is so critical. So if we take a look at the next slide, I'll give you just a bit on Launch New York and the eco incubator that comes into play as we work in this arena. So today's session and our whole series, really thanks to NYSERDA, we've been focusing more so on the deep tech side of the startup realm, and particularly on the clean energy piece of that. So Launch New York, as we talked a little bit about the mentorship programs and the capital access we provide, we are very fortunate because of funding back in starting in 2018 that helped us create the Emerging Clean Tech Opportunity, or Eco Incubator, where we provide one-on-one mentorship, access to a plethora of additional resources in this sector, industry experts through both kind of in-house mentors as well as those over what we call the National Mentor Network. So you can see big numbers of trying to connect you to the type of resources that you need. So we obviously are here to look at those kinds of initiatives that can provide products and services that decrease greenhouse gas emissions, provide other energy efficiency solutions and the like. So we're thrilled to be part of this today, and we have dozens of companies who participate in the Eco Incubator. So we certainly want people to know that Launch New York is open for business. And I can show you briefly how we do what we do at Launch New York on the next slide. So the coaching and the capital, we have a mission to identify, support, and invest in high growth companies, with one of our specialty programs being the Eco program, as I noted. So we have worked with over 1,800 companies providing pro bono mentorship, which has yielded over 5,900 jobs in upstate New York. We focused traditionally in the 27 westernmost counties of New York State, and I'm proud to announce that we just did a press release a day ago that we have expanded to the Albany region. But we have many partners that address all of upstate New York, and because the clean energy sector really has so much depth and breadth to it, we actually have even a much larger affiliation with many entities across the Northeast and across the US. So we start out working with any startup as a mentorship relationship. So rather than you applying to launch New York for venture capital, we are the most active seed fund in New York State. We will lead your seed round. It is equity capital. So we'll be diving deeply into how this differs from the non-dilutive funding sources that Jillian will be talking about today. But we do start out with a mentorship role. And then that leads to your application. And every Thursday, a company is pitching Launch New York virtually for funding, which typically is going to be ranging from $100,000 to $250,000 for a first-time company investment. And then we do participate in follow-on rounds. Plus, we will be there to support you through the portfolio management phase, helping you look for that Series A lead. I'm very excited that we currently have a clean energy company that we've invested $250,000 in just a few mere months ago, and that company has actually already found a Series A lead, and we are participating again at an even more significant level in what is essentially their Series A. So as we talk today, I guess I want to motivate a lot of you that we're in an interesting environment right now, but it's one where deal making is happening, and a lot of it's happening virtually and connecting you with the resources you need, such as we're doing through the webinar today. So next slide. So these are the programs we have available. I won't dive into depth, just to let you know, we have a variety of funds. I'm excited that we just closed on $15.775 million from 85 limited partners in our second limited partner fund. And we also, for certain companies in eligible areas, have a nonprofit seed fund, and that's how we put together what can be the 200 to 250K for a first-time investment. Plus, we also have an investor network available that fields deals actually on our syndicate. It's the only platform online dedicated to fielding upstate New York investment opportunities. One of the opportunities that will be coming up soon is a company called Dimensional Energy, and I'm super thrilled to announce that it's been a long time portfolio company that originated in the Ithaca area. They have a sustainable aviation fuel product, and that company has just recently publicly announced a partnership with Boeing. But they already were a company that when we invested, our investment was at a valuation cap of $3.5 million, and they are now at this point of 100 million plus in terms of evaluation. So there's a lot of exciting things going on, which makes today's webinar even more important for all of us to hear about. So I'm pleased to introduce Jillian. I'll let her give you the deep dive on her bio, but I would just tell you one thing that's been important for us is to not just, quote, stay home when we're building the relationships for our startups to flourish. Launch New York is all about supporting startups in all sectors. But we realize that each sector has its own uniqueness. And we know, for example, in the clean tech sector, that there are significant infrastructure costs, equipment, facilities, CapEx, basically. And this is where we said, gee, what more can we do? Because our companies, as they are growing, they're facing really significant fundraising challenges because of the size of what they have to raise. So that's just one element that's unique. So getting to know Jillian over the past about 2 years now, we did forge a formal partnership with Rapid Ventures that was announced publicly last fall. So I'm thrilled to have Jillian take the stage, and then we'll follow that up with a fireside chat.
Great. Thank you, Marnie. Hello, everyone. Thank you for joining us today. So I will go through a few slides on Rapid and then talk about the components of a good capital strategy, and then we'll start with the questions. Although this webinar is geared more to climate tech and deep tech, just as Marnie mentioned, where there is a significant jump from the initial capital raise to the next round, we still can have the flexibility of answering some of your questions that might not be specific to climate and might be on other industries. Next slide, please. So who we are. Rapid Ventures is a climate tech acceleration studio, and why we say acceleration studio is because we do bespoke attention to this commercialization financing gap that we're seeing that can be complemented or supplemented with non-capital. So that stage that we really look at is, seed to Series A, and where you already have a minimum viable product. And so the next stage is to pilot or to introduce your product into your beachhead, or proving out your business model in your beachhead. So we really focus on bridging that gap between the commercialization gap, and supplementing that with non-dilutive funding. And just so you know, we are actually going to provide a copy of the slide, so you don't have to read everything on this slide. I know it's pretty dense. We also identify investors on the non-dilutive as well as the dilutive side that have more of impact goals. Because one of our theories and the things that we think could be a good use of resources is there are opportunities in underinvested communities where there's a high impact goals, and you can access some of the financing coming with other criteria that they'll look at besides just financial goals. We also work with startups that, as I mentioned before, have an MVP and are looking for market validation. So we work closely with off-takers or market adopters and able to introduce the startups that we work with to either communities as well as municipalities and cities that might be looking for technologies to address their challenges. Next slide, please. So just a little bit back on my background. My background is, years in capital markets, impact investing, climate tech, commercialization, working with startups since 2016 as an EIR or a mentor, helping them structure non-dilutive funding as well as guiding them through the pilot to scale transition, and then also helping with product market fit. And then just also right now, what we're looking at is helping to educate some of these non-dilutive funders that historically haven't looked at clean energy and are now looking at clean energy. I'll get into that a little bit in the following slides. Next slide, please. So yeah, sorry, the slides seem to kind of be jumbled, but basically our vision is that we're looking at a sub ecosystem of climate tech where there are market adopters that are looking for the challenges. So we have those market adopters identified and are part of our ecosystem. And then we also have the technologies from the startups that are scalable and can be applicable to corporates or communities. And then the investors and financial institutions, like ones that historically probably would not be incentivized to enter into the market, but are now being incentivized given different structures that we'll get into a little bit later. So the market opportunity around this in climate is just is that there's an evolving climate tech financing. As we mentioned, there's a more capital that's needed, specifically in deep tech, where you need to actually maybe build a plant, or you need to have upfront capital in order to deploy your technology and then receive revenue. And so there's a mismatch of either working capital, or historically maybe you've used your equity, which is something that obviously equity providers don't want you to do, for your CapEx as opposed to the OpEx. So there's that opportunity now to have an ecosystem with different types of financial products that are being created in order to help finance and move you from that seed to Series A, or your MVP pilot to scaling. And then there's just also driving economic growth in underserved communities as well as underinvested communities. So across the board, we're seeing communities that have the need for infrastructure and the upgrade of that infrastructure and need to be a part of the energy transition. And so with that, again, there are opportunities, funds being created, other historically, again, what they call community development financial institutions that are entering into the market and providing more resources. And then you have the states and cities, because there's a drive to for economic development, decarbonization, they are also entering into the market in order to provide products that financial products that are going to help to startups for scalability. Okay, next slide, please. So this is just talking a little bit about our focus areas, again, because it's tied to a lot of infrastructure. We're looking at mobility and logistics, so transportation, EV charging, auto advanced buildings, which is smart buildings, energy efficiency, any retrofitting solutions, and then energy, clean energy and grid modernization. So renewable energy, advanced storage solutions, and what the startups that we work with, we actually, they are addressing critical climate challenges for corporations and communities and require the non-dilutive funding in order to reach market adoption and can drive economic and social responsible innovations. Next slide. So just to give you more of an idea of kind of like where we sit, and as we're talking about, you know, TRL, a lot of you understand this, given which is your technology readiness level. And there's a good mapping here of, you know, what you go through with research first, like your TRL 1 to 3. You have like the National Science Foundation's programs in order to and other grants that historically have come from the Fed. And now that we're seeing that there might be a pullback on some of those, there are a lot of other like family offices and foundations really thinking about how they can fill that gap in order to underwrite your technology. And then you're also seeing states and cities offering opportunity as well. Some of them are in the beginning stages of doing that because there was, you know, given the new administration, there was a pivot that they had to happen, right? And so a lot of them now are thinking about, you know, if this federal funding does not come back, how can we help to fill the gaps? And so, as I mentioned, you have the states and the cities, as well as foundations and family offices that are stepping up for that. And so where we actually sit is more in the pilot to the first of a kind, you know, transaction or development, because that's really where we're seeing the need for more structured kind of non-dilutive funding. And so, as you can see, just with the seed, it's usually you already have a minimum viable product, and now you need to do a product market fit and begin your business development efforts. And then Series A, again, is where there's usually now, given deep tech, a jump in that finance commercialization and market adoption and traction phase. Okay, next slide, please. Okay, so one of the things that, you know, just to kind of like level set and understanding the components of a good like capital strategy, right? So you have capital, a lot of the times what has happened in the past, and I think, you know, obviously you're busy with your technology and everything. It's been kind of like, okay, we're in this phase, let's really think about, okay, where can we access capital, all of that. But what we're seeing is, especially if you're involved in deep tech, you really need to, from the gate, have a capital strategy that addresses every stage that you're going through. So as I mentioned in the slide before with the TRL, you go from 100% grants and you get those to help develop your technology. And that's considered probably maybe your first like pre-seed kind of funding, but federal or actually, government will help you to kind of fund that. And then you move more into a 50-50 kind of structure where you then need more capital. So as you're going through your equity, sorry, as you're going through that, really you should initially have a good capital strategy that's comprehensive, right? So it's holistic, it's intentional, it really aligns with your business strategy and your development strategy. And then it also has to be evolving, as I'm saying, it has to be like iterative, adapts to the needs at each stage. And then one of the things that a lot of startups don't really think about is, having it be relationship based, right? So it's not just applying to all of these non-dilutive funding and then hoping for the best. Sometimes you have to be in the mix and understand what are the things that might be coming up as grant opportunities. So for like NYSERDA, they have a list of things you can actually look at their strategies and kind of what they've promised that they're going to do with their ratepayers who are their interested parties, and then almost be ahead of well, it looks like they're going to do something around EV charging or something, and really get yourself positioned there. And also, it's not only relationship with those entities, but having a good relationship with your dilutive funders, so your equity providers as well, can help you to really be ingrained in the ecosystem. And then it has to be transparent. So going back to who are your investors, being transparent with them when you're bringing on new equity providers or new non-dilutive providers, and really being informative about what you're doing so they can either help, right? So Launch New York has a lot of resources and contacts in upstate New York, and they're able to help to kind of like facilitate those partnerships. So really, those are the components of a good capital strategy. And just on the side, it's just talking about, venture is no longer able enough to kind of, fill those gaps. So that's why it's really, again, thinking about it holistically. How do we approach this from all angles? And really, again, going to more like a stackable capital strategy. Next slide, please. And so what I mean by stackable is using all different types of opportunities, financing opportunities, as well as grants, tax credits, rebates, and thinking about that again holistically. So, in a stackable capital strategy, you're going to have like the non-dilutive funding. Everyone's pretty aware of that, and what that is: tax credits, incentives. You have incentives that you can get from NYSERDA and grants, and then you have the Empire State Development Corp. They also have that, and just from the state itself, manufacturing tax credits, incentives, things, and then you have some will offer revenue-based financing, asset-based financing. So thinking about that instead of just a regular loan, but if your project includes equipment, can we get equipment financing, any kind of bridge financing? And then, so that's like, your traditional kind of non-dilutive funding. But then there's also catalytic capital, right? And so you have organizations like the Lacey Fund, which is the Los Angeles Clean Energy Incubator. They have a debt fund where they actually don't ask for personal guarantees. They are looking at underwriting in a different way. So they you have to be recommended by one of their partners. And what they do is they consider kind of your experience in the ecosystem and, your partnerships. And then they also underwrite, with a little bit more concessionary, right? And concessionary meaning, lower interest rate, because they themselves are actually grant based, and so they're able to have a lower interest rate and not be usury. And so you have those kind of like concessionary opportunities and through catalytic capital. And then you have the mission aligned capital. And so those are like your impact funds that are, yes, they're looking for a financial returns, but then they're also looking for the impact that your project will achieve on the social and environmental side. And so those mission aligned capital can also be, debt. So you have Lacey that's catalytic and mission aligned, and then some you might just have mission aligned, but not necessarily catalytic, where Lacey is really looking at more on the impact side as opposed to the financial side. So next slide, please. So one of the examples that we have is Dollar Ride. And so Rapid's been working with them. They are located in New York, went through a process and actually received a $10 million grant from NYSERDA. And that grant was to help them expand their clean transportation access program. And that was to help to electrify small fleets in underserved communities. So they're a really good example of, okay, they saw that there was a need for that NYSERDA had their goals in order to decarbonize underserved communities. And Dollar Ride saw that there was a need. They actually entered a competition, won that competition, and now they are bringing other financing solutions in order to build out this program, the CTAP program. So before even this program was created, Dollar Ride was working with SAFES and a D-Safe, and which was created by Elemental, which is a development safe, also helped them. We mentioned Dimensional Energy. They also received a development safe. So this was a new product based on, safes that Y Combinator created. But this one was specifically for upfront capital that's needed when you're doing a development, because they are buying assets and they're also developing charters. And then some of the other non-dilutive funding that we've helped them to access are new market tax credits that historically have been for real estate, but now you have the participants in the structure actually looking for opportunities to bring new market tax credits to clean energy. They also have utility rebates that's in this structure, a bridge loan from a blended finance fund called the Candide Group. And then they also have additional grants. So it's really, again, thinking about where are your gaps, how do you stack those in a more structured way and more intentional way. Next slide, please. And then this is just our ecosystem, some of our startups that we're working with, some that are in our community where we've helped them with different strategies and thinking about their product market fit, and then listed the partnership with Launch, Lacey, I mentioned as well. And then we are part of a strategic investors group for advanced photonics. So really, again, there's a focus here at Rapid to think more about deep technologies and using climate, the climate space to kind of help us to develop new products that will help to permeate other deep technologies. And so I think I will stop there. And then we can start the Q&A session.
Great, thanks so much. So Taylor, I think we can unshare, and we'll just look forward to a couple of things here. One, want to thank you so much for the presentation to kind of set the stage here and giving us the great example of Dollar Ride. Want to thank the audience for submitting some questions ahead, so we'll dive into those as well. But I want to also offer, if any of you feel so bold as to come off of mute and want to jump in at any point, please do so, and or you can put your questions in the chat, and Taylor will help to monitor those. So first of all, just to clarify for everyone, so you need to be out there raising from all kinds of sources. And, there was a point at which I think everyone would have us all believe that it all needs to come in as equity capital from venture capital firms. The reality is areas, particularly in deep tech, like the clean energy scenarios we've been talking about, those can be few and far between. So they're a piece of the puzzle, but probably for any sector, any of your startups are in, you need to think about this blended strategy. So I want to dive in a little bit deeper, because we basically have talked about kind of two types of non-dilutive funding: grant funding and debt financing. So let me switch over to the debt financing a little bit, because we know grants, there's a whole process. And I think every one of these, as you said, Jillian, you need to have a relationship. But I'd love to kind of revisit some of what you mentioned with Dollar Ride, but let's talk about these debt financing entities and how it differs then, for example, going to a bank and going through a typical underwriting process. So if you decide you want to look at this kind of financing, what should the entrepreneurs expect this underwriting or due diligence or whatever they call it in these types of scenarios? Walk us through a little bit of what that's like.
Sure. So I think, when with a traditional bank, I think all of us understand this, but their risk return appetite is high, right? So in terms of, they view a lot of these early technologies as high risk, right? So when you're approaching them, and you're either going to be required to do personal guarantees, or it's going to be a high interest rate, right? It's just the nature of the beast. What's happening is there has been historically these banks called community development financial institutions, right? And they were, think of your traditional like community banks, right? Community banks, once they understand the community, they're a little bit more willing to put capital into that community. So you have the community financial institutions that historically have been given money from the federal government. They've also been given money from foundations in order to build up their relationship in the community. What was happening, they saw historically when larger banks were acquiring these smaller banks, they actually were not putting money back, but taking the money and put it and investing outside of a community, which was depressing the community. So now you have this commercial financial institutions. They historically have been funding a lot of the affordable housing, small businesses, and now see that they need to pivot to clean energy because these are the new industries, right? And so with that, they are looking at it more of a lens of, we know we're going to be the first lender here, right? So let's really think about how we underwrite, but we're not going to underwrite it with traditional. So maybe in the debt coverage service, they are lowering that, right? They're also able to use some grants that they've received for a first loan loss guarantee, right? And so that is kind of how they start to look at it and say, look, we're going to take this risk. We know it's very risky, and any traditional ones would believe that it's risky, but we're able to supplement that and bring in private capital. So when you start to think about your strategy, sometimes the best thing is to figure out, the community development financial institutions, there's a lot of them within your own, especially in upstate New York, they have where even like a larger bank might have some of that community development financial institution relationships where they can say, hey, we can't invest, but if you go through these, you'll get better terms and better underwriting. So there's just the social aspect starts to outweigh more on the financial side because these community financial institutions aren't looking for high interest rates. What they're really looking is for high impact.
And would they be asking for, credit score or looking at credit scores, or is that really put aside?
Yeah, so they would be looking more to underwrite your project. So they are looking at more project based. So it's almost like project based financing, but on a smaller scale. Because again, project based financing is usually for like the larger deals, right? So they will look at things like, for instance, Lacey Fund is no personal guarantee. They're not looking at credit scores, right? They are looking more at this is your first customer. You already have a contract in hand, right? Maybe you need some working capital, but we'll underwrite to the contract that you have. And then sometimes in some instances, they might underwrite to, an equity raise, but not in the sense of like venture debt, because they won't have any equity position after. But they'll say, hey, okay, we can see you're raising capital. You also have a first customer. So now you're holistically, you look like a better kind of, operation or a startup, a more healthy startup, right? You have a capital raise going, and then you're also getting traction. So they're underwrite to that.
So Jillian, we tend to think about, and want to see if this resonates for you. We tend to think about the venture capital we provide. And by the way, we are a CDFI for any of you who are not familiar. So the definition of a CDFI is financing entities in low income census tracts and financing entities that particularly are frankly unbankable. Okay, so we already know that's where we live, and I have debt financing partners, but we tend to think about our equity capital as important to use for your the working capital you need for your operational capital, where we don't really like to see that money being consumed by a heavy capex. So you're buying equipment and other sort of facilities build out. That's really where we're saying, you need to look at some of these incentive programs, and whether you're looking at, a NYSERDA, because even equipment that can tap into a variety of other programs, but the state. So does that resonate with you as a way that our entrepreneurs should be thinking about the debt financing versus the equity?
Yes, exactly it. But to your point, Marnie, they're supposed to be using the equity to, get revenue in a sense, right? And not CapEx. So it's using the equity, whether you want to build out your business development team, or if it's, more about product market fit, maybe tweaks, you're not underwriting the heavy technology side, but you're underwriting that kind of commercialization and getting to your first customer or your pilot or whatever, but not using resources that are CapEx heavy in order to build your product and then, deploy it, right? And I think also going back, and we talked about this a little bit too, Marnie, in terms of, grants also should be used for that purpose as well, right? To get your model refined, and then it shouldn't be considered revenue, right? So it's almost like all of these things have to fit really well together. Grants, again, yes, this will help you get refine your model, and then the next step should be from that kind of pilot, you're getting revenue and not a reliance on grants to say, oh, this is revenue for the first 2 years or whatever it is, right? Especially
And
when you're
that's super
in
common. I think, we chatted about the fact that when we, many of you know, we're the most active seed fund in the state. So we've invested in 108 companies. So when we get a lot of financials, oftentimes the grant revenue is, the grant dollars are being reflected as revenue, and that really has to be understood strategically and from a bookkeeping standpoint as a separate entity, or a separate piece of the puzzle. So when we talk about using these debt financing vehicles, of course, startups, many of them are pre-revenue, and maybe they're getting a paid pilot, maybe it's an unpaid pilot. So I'm the entrepreneur saying, how in the world am I going to be paying back? If I'm thinking of traditional debt, I sign the papers and I have my first payment coming very soon. So how does the payback scenario work with these kinds of resources that you're saying can support, especially deep tech?
So with pre-revenue, we are seeing people move more to like revenue-based financing. So they will base the financing, you have like, paid pilot, and then or you have your first customer. And we're seeing a lot of like the CDFIs and some community banks being like, okay, we will do a revenue based. So depending on, say, every month, that can change the payback, the schedule, right? So if you're not getting revenue for, until like a certain quarter, then that's when you pay back. So they try to match it with kind of feel like your contracts and your expectation of revenue. And so they, depending on the underwriting, will obviously, charge instead of an interest rate, they're looking for, X times what they've lent as a return.
And so with Lacey, for example, what
Mhm.
is a typical payback scenario for them?
No, Lacey's strict loan. So they will lend, it's 9% is the interest rate. And again, they underwrite using mission-driven finance, which is another entity. So mission-driven finance actually services Lacey's loan. And under mission-driven finance, they have other programs that they run as well. So they have like Advanced California, and they have some others where they will also underwrite with no personal guarantee. But what they're looking at, again, is the financial stability of the startup. So how have you maybe historically used your funds? Have you been prudent in doing that, right? And then they will also look at, what will be the revenue streams coming off of the project, and the payback period on that. So they're looking at that. And historically, when you're looking at more traditional, they might look at that, but then they're asking for like personal guarantees and things like that are pretty onerous. And Marnie, as you have mentioned, that's not what and we know what VC likes to see. They don't like to see personal guarantees, or you're signing on to personal guarantees.
Yeah, I will admit it's a bit of a trick, a challenge, if you will, because we don't love to see that there's an active loan being paid back with equity financing. So, I would encourage that there is an overall thought process, working with advisors, working with your management team, working with your board, and working with ecosystem partners to design how you're approaching this. Because so what you're explaining to me is some of what they're looking at as a debt financer, even though they're sort of off their traditional metrics and criteria, in some respects, there's some similarities. I mean, as a equity investor, I want to see, what is your forecast? What is your use of funds? I want to see track record in being prudent in how you've actually used those funds. So it does sound like it's almost a case by case, particularly for deep tech, since we do have many new funders kind of entering the space. Speaking of new funders, so can you talk a bit about the Green Bank phenomenon. Certainly New York Green Bank, but other states are doing that as well. And how should our clean energy founders and startups be thinking about those programs?
Yeah, so it's a good question on that because it's really New York Green Bank is probably one of the oldest, I would think, and the biggest, right? And so they've been around. Is it 10 years? I might get this wrong. I think about 10 years, I want to say.
Sounds good.
So they've been around for quite a bit, and now you're seeing others pop up. Connecticut Green Bank, New Jersey just created their own Green Bank, and then New Orleans also changed their finance. New Orleans, which was historically, affordable housing. It still is, but what they've added is a component of clean energy as well and climate because they understand, all of that kind of goes hand in hand. The infrastructure has to be upgraded, whether that's housing or other social infrastructure. So you're seeing a lot of states think about that because one of the components that's important for them to support startups is creating, new industries and economies, right? So they're looking to provide jobs, they're looking to provide resources to their states. And so New York Green Bank does a lot of different products. They've funded, EV charging. They have, and I believe they did a big one with Revel. Just maybe last month, I think it was $60 million or something that they've provided facility for. And then they also work with, some retrofitting and housing. They have a decarbonization fund where some of these CDFIs are accessing capital from that fund in order to deploy related to energy efficiency, EV charging, energy storage. So there's a lot of different under the kind of like green bank umbrella. And again, green banks are that catalytic capital, right? So they're using state funding in order to help kind of bridge that, that area where there's a lot of risk. And so they might come in and maybe provide the first loan guarantee or some sort of other credit enhancement in order to de-risk the project, so make it less risky for private capital to come in. So the green banks, they don't one thing with the green banks, they don't want to fund your project and be the only funder in there. They're really that tool to be catalytic and bring in private funding in, because that's really the name of the game. The whole thing is, how do we make it, because no amount of concessionary financing or catalytic capital is going to be able to finance, these new industries and technologies. Like private capital really is what should be coming into these areas. And so really right now there's like a focus on how do we really use blended finance in order to bring in private capital and the more traditional.
So let's chase that down a little bit because you talked about there's a couple points I want to make here with you. Like $60 million is a lot of money. So some of the folks, one of the questions that came in is how much money should they be thinking about? And if you're talking 60 million, how much what I'll call match, and I know it's not always really considered match in the traditional way, but one of the things we're seeing is your same message. You've got to have multiple sources, and you need to be able to talk about that and talk about how they work together. But importantly, for our startups, you have to time these to work together. So committing to one and going down that path alone without thinking about the other often can, bite you in the sense that you miss the opportunity to use that match. So kind of curious here, what scope of dollars should our founders be thinking of when it comes to either the debt financing or grants? I mean, what's the reality of what they could really pull in from those avenues?
Okay. So yes, you brought up a good point on this. So most green banks are looking for bigger projects, right? So that's just the nature of the beast because their transaction costs are high compared to them doing or the same as if they do a $60 million deal versus a $5 million deal, right? So New York Green Bank usually doesn't like to go below 5 to 10 million in terms of lending, right? That kind of brings us to where, like, Rapid is fitting in. We're seeing smaller deals, right? The deal that we did with Dollar Ride, or even working with like Volt Post on some of their deals, it's lower. It's probably we're looking at 2 to 3 million. Yes, CTAP was a little bit larger, but it still was too small for one lender like New York Green Bank to enter, right? So it's we're kind of going a little bit on the smaller side, so that addresses some angst around do I need to be like a big deal? No, it really focuses more on how much do you need for your project, right? To get that kind of like flywheel going where you're using the capital to build out your business, right? So that's like very specific around there. With Lacey Fund, what's good about Lacey Fund, they can go up to they're looking at like smaller size checks, right? So they go up to say 500K or 750, right? And then they might bring in, like, for instance, working with Wallpost, we're bringing in Lacey Fund, and then we could also bring in, Mission Driven, which works with Lacey. So really thinking about, again, like, where are the different sources to make up your capital stack? This is the most difficult and bespoke area because the check sizes are usually smaller, but you still need it in order to really, get your project going. And traditional financing also is not going to look at it because one is too risky, and also it's too small of a deal for them they would have to charge too much for it because of their transaction costs. So right now I mentioned a $60 million deal, but just to give some color around, the Green Bank and kind of what they're looking at, but they're usually looking at larger deals.
And I think one of the key things to remind our founders to think about is, even when you're doing a smaller round, you are building relationships and you're establishing your track record of being a good customer to that lender, to that investor, to that grantor. And that's invaluable because now you will be looked at as a customer that is very desirable going forward. And when you need more money, you have a leg to stand on to show that you could be a good place to put that bet. I'm curious how you think the startup should view the risks associated with taking, let's focus on debt, continue focusing on debt versus equity.
Oh, the risk. Well, yeah, I mean, I think, obviously equity is what they say is expensive, right? Because you're giving up a portion of your company. Again, it's all, and I know, we don't want to keep beating a dead horse, but it really is, at every stage you have to continue to do your analysis on, okay, so we understand, yes, pre-seed and seed, you need to raise equity. You have to be very intentional about how much that is, how much that runway is going to last. Like, we have seen startups raise and then they're raising for, like a 6 month or 8 month runway, right? Like, there has to be strategy around that of, something like, and Marnie, you could probably say better. I would think more like a 12 to 18 month, right? In order to really get, the traction, the product market fit, whatever else that you need to do done, you have to give yourself like a reasonable amount of time. And so you have to then figure out the money that's going to help you in your runway for that time. And so that's kind of like the equity side. Now, when you're taking on debt, you like, the whole thing is, every month there's something that's due, right? So you have to be really mindful of that. And I know historically sometimes like equity has been like, no, we don't want you to take on debt. But that was more if you're software, maybe that's an easier thing to do, right? You don't necessarily have to take on debt. You start to look towards in that stackable capital profitability, right? And you're looking at not just revenues, but are you making money from what you're doing, right? And so, but with non-dilutive now, you do have to introduce debt. So it becomes, again, a process of, I know sometimes you feel like you need the debt right away, and you probably do. That means you should have probably planned a little bit better, right? Because I'm seeing startups go out and get this really high percentage debt, right? And using credit cards and all of that stuff. So again, like your capital has to be as much time and effort you put into your business model, you have to put into your capital strategy model, right?
Yeah, and that cost of capital is in a different way, right?
Yeah.
So I know we're going to be right at the top of the hour shortly here. Certainly, also welcome any chat questions. But I know there's a lot more questions that we received, and we'll look to see if we can kind of send out some answers on those or some questions on tax implications. I mean, what we're essentially getting to is the question, my final question for you, which is, how does a company begin to create this strategy? Where do they go to find resources to help with both that planning as well as finding the specific tactical avenues they can pursue?
Launch New York.
We are certainly one solution to reach
Yeah, I know.
as is Rapid Ventures.
Right. Yeah. Which is, and it kind of goes back to like the relationship building. I mean, you know, um, I think it's a good practice, and it seems like many of you that are on this have already done that to determine your like beachhead ecosystem, right? Okay, which ecosystem do you want to enter, and where you're going to put, full effort and time into developing those relationships with accelerators, right? With other programs. Some now include workforce development programs, right? So maybe there are also opportunities to leverage a grant that another startup or workforce development is getting, right? Because you can incorporate, like if you have a component where you are, building out or helping to build out a new workforce. Like I'm going to use EV charging as a example, where you're building out a workforce to work on EV charging. There's like grants for that too, right? So again, just like thinking about how to bring everything together from the beginning and building those relationships. I know we don't want to sound like, we're being repetitive, but it really is relationship building and having your plan be evolving and iterative. And
I love that as a way to wrap here, because what I was asked to be part of a presentation on fundraising, and they say, want to hear about programs in New York? And I said, well, where in New York? And the reality is you should take advantage of your beachhead. We are part of the Upstate New York Battery Storage Engine, which is a National Science Foundation funded effort. And we've had numerous companies who are interested in being part of it. And I give them credit because they're reaching out, not just looking up, on the web, what are the programs and just applying willy-nilly, but they're actually making the phone calls and then connecting. And we are mapping exactly what's an eligible source for them by literally what city and sometimes even what address. So, where you want to set up your beachhead in terms of strategic partnerships, your physical location, as well as your customers, really becomes so important. So I appreciate your reflecting on what really is a very complicated landscape, but one that certainly you know, I think there are resources like us, many of the accelerators and many of the partners you had on your slides really are phenomenal partners, because it does take a true village for any of these companies to succeed, particularly when it takes years to bring your technology to market in some cases.
Yeah.
Great. Well, I want to thank all of you for joining today, and we look forward to having many of you join our next webinar. We want to thank NYSERDA for supporting this entire series, and we certainly welcome you to be in touch with any of us. We will follow up with an email, so you have contacts, as well as the recording from today as well. Thanks all.
Thanks, everyone. Take care.